You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in to the Generational Wealth Through Commercial Real Estate show. It's your host, Will Smith, and I'm here with Jamie Gruber. He's a beast in the multifamily space. He has his Facebook groups, Multifamily and More. He has multiple chapters across the U.S. right now, and his portfolio currently consists of 42 units. Jamie, how we doing today, man?
Doing great, man. Happy to be here. So honored that you invited me.
Absolutely, man. I'm excited to have you on the show. I know you're about to add some value. So, man, just tell us real quick. That was a really quick bio. Tell us who you are and how you got into real estate.
Yeah. So you mentioned I'm Jamie. I've started investing in real estate accidentally in 2005, meaning I had a single family home I couldn't sell, moved to another city from New York to Boston, and kind of held on to that property, rented it out, hoped that one day I could just, the market would turn around and I would sell it, but everything crashed down in 2008. But years later, about 12 years later, I kind of got the itch for real estate again. This was probably 2017 or 2016, 2017. Started looking at smaller, like single family duplexes, because that's what I knew. I'd listened to the Bigger Pockets podcast and all that stuff, and multifamily just seemed so big and so, intimidating. So my wife and I found a couple of duplexes that are not too far from where that single family home that we owned in upstate New York was. This is while we were living in Boston. Since then moved to Michigan. And in Michigan, I've really learned a lot about multifamily, like the idea of buying smaller apartment buildings seemed less intimidating than what I initially thought multifamily to be, which was these terms like syndication and, IRR and all this other stuff just kind of freaked me out. So smaller multifamily seemed more doable. And we really learned from the two duplexes that there's a lot of work, 2 different tax bills, 2 different mortgages, 2 different everything for 4 doors, where if you could buy 1, 10 or 20 or 30 or 15 unit building, it's all one purchase and all in one spot. So found a partner, joined a mastermind, and learned a little bit more about multifamily. Bought a 16-unit property in Michigan. That was in late 2018, almost 2019. And then later on in early 2020, bought a 22-unit with some partners in Cleveland, and that's where I sit.
Yeah, nice. No, that's a great story, and I imagine a lot of my listeners can relate to that, because there's people that are, doing the single family game right now, and they're, ready to jump into multifamily, but it's that fear of, man, like, just like you said, I hear these syndication terms and people talking about buying 100, 200 unit buildings. Like, I don't know, so I appreciate you sharing that, man. Let's talk about how you got to, where you at now as far as, the relationship side of it, because that's huge when you're talking about, buying multifamily.
Yeah, 100%. And that was the learning early on. So when you're going from single family to multifamily, there's a gap between those two things as far as the process, right? So single family is like, okay, I find an agent walks me around, shows me a couple different places, or maybe you find a wholesaler or whatever, but you kind of go that route. You buy a house, you go get a certain type of financing that we're all familiar with, like 30-year mortgage, that whole thing, right? Then you go over to the commercial side, and there aren't agents per se, there's brokers. But brokers sell to exclusive lists of buyers that have bought from them before. So it's not like you just knock on the door of a broker and then you get this flood of listings. I mean, you might, but they're probably already passed through 2 or 3 buyers lists that they've already sent it to. So big learning for us was, even though I had at the time when I was going into multifamily, I had 2 single family and 2 duplexes, and my partner had some single family rentals. We thought, okay, well, we got some experience. We're not just like brand new to this. So brokers will take us seriously. And it's not that they didn't, but at the same time, there was really no desire or no need for them to prioritize us when they have 4, 5, 10 people that buy from them consistently. So for us, it became, all right, well, how do we break through? Because it's like a chicken and egg thing, right? Like, I need the broker to get the deal, but I need the experience to get the broker, right? So like, how do I do this? So what we decided to do, my partner and I, was, hey, let's sort of, get a little bit more of a face in the multifamily market, at least our local multifamily market. So we started a meetup We called it Multifamily and More because we weren't
Yeah.
sure if people would come for multifamily. Like there was no
Right.
other multifamily meetup, right? So
Right.
More gave us some outs. And so we started the meetup. We had about 15 people show up at the first one, which was great, more than I expected, but all wanted multifamily. So it was clear there was a need here. And as we started to put content together and deliver on that content and go from like, what can we get out of this to what can we give to people? What kind of content and connection can we give to people? As we converted in that way, deals started coming to us, capital started coming to us. So we worried less about the take. We worried more about the give. And things started to happen. So that first 16 unit came from networking within our meetup. The 22 unit came because our meetup expanded to other cities, and the leader of a Cleveland chapter had this deal and brought us in on it. So, all from networking, all from just sort of putting content out there, building a brand, adding value, or at least trying to people. And the return just sort of came, I guess, with intention, but not with intention, if that makes any sense.
Right. Well, you definitely got to dig a little deeper on that, man. You just dropped some gold there for the ones that's listening. It's like, man, that sounds like a great idea, about, starting the chapter. So if you would, man, talk to the listener that's right where you were at, a few years back, and they're ready to do this, but they don't know exactly how. Like, what are the actual steps that's required to go out and launch something like you have, and even tell them about maybe how they can partner with you and your chapter?
Sure. Yeah. So I would start with this before I even get into the tactical aspect of building a meetup. Is you have to have a no holds barred mindset, right? Like the mindset piece. I spend a lot of time here. I think it's essential. I think it's part and parcel with the investor makeup. Like the successful investors, they read mindset books. They read books on law of attraction. They read books on, how to overcome limiting beliefs, on imposter syndrome, on all that stuff. So when it comes to this, like, it's hard to break into multifamily. It just is. So your persistence, the consistency that you demonstrate, all stems from whether or not you've done the mind work. You've done the work on you, on whether or not you're willing to put forth extraordinary effort, honestly, to achieve what you're looking to, because you're going to meet a lot of resistance. Brokers, deal flow, cap rates right now are just going down and down. Like the properties are more expensive, right? So to try to find a property that brokers haven't already kind of circled around, that's off market, if that's what you're trying to do, that's going to take a level of persistence and maybe some capital that you have to put into it. To get brokers to take you seriously, it's going to take a level of persistence. So first step is you've got to be working on the mind. You got to be working on are you willing to put forth extraordinary effort? And it's not like we sat there and said, we're going to put forth extraordinary effort, but by creating the meetup, that was our way of saying, okay, this avenue is blocked direct to brokers more than we thought it would be. Even though we devised a great plan, a business plan, we gave that to them. We showed them our criteria. We did more than most people do when they go and meet a broker. We still weren't taken seriously. So we had to go another route, right? So you have to get in your mind that it's going to be no matter what, no holds barred, I'm going to get there. So that's number one. As far as building a meetup, my lesson, and I mentioned in the beginning, was when we started the meetup, it was, hey, you know what we could get? We can get people to invest with us, and we can get people to bring us deals, and we can get notoriety, and we can get, a face in the market. This is the stuff that we can get. And as we went month after month of doing it, what I learned was it's not about what you can get, it's what you can give. And we all want to get out of something that we're putting into, of course, but it really truly is what you can give. And at this point, my partner and I kind of aligned. I talked about mindset. I talked about extraordinary effort. I talked about what you can give. We aligned around 3 core values for the Multifamily and More brand, which are very simply give more, be more, do more, right? So everything we do, we try to lean into those 3 core values. So are we giving enough of our content? Are we giving enough of the time and the energy that we need to the people that patronize our Facebook groups? Are we being more? Are we working on the mindset? Are we trying to elevate ourselves to be at the level that we want to be, to vibrate at that level, if you will? And are we doing enough? Are we doing more to accomplish the goals we want to accomplish? So first and foremost is you got to give versus get, that mindset going into creating a meetup. After that, honestly, tactically, we went on meetup.com. We created the meetup. It's very simple to do. You can create up to 3 different meetup groups if you want on Meetup for free. You don't need to have a paid membership or anything like that, but we put it out there. What I did was I went around to all the other meetups that I could find within the general area that were related, not like real estate meetups per se, although I went to a few of those, but there's a lot of like what's crypto, like crypto meetups and financial security meetups and financial freedom meetups and stuff like that, stuff that relates to real estate. So I found those meetups and I messaged members. I just said, hey, just a heads up, we're starting a meetup over here. I even messaged the organizer, like, hey, just so you know, we're doing this meetup. And from that, we got some traction. We got people kind of joining our meetup page. We put the event in there. When you're creating an event in Meetup as well, Meetup will prioritize it if you're active in it. So post comments, put a few pictures in there, go in every couple of days, like, hey, excited about the event coming up, and it'll get seen more, it'll get pushed more. So we leveraged Meetup. In between, we felt like, okay, we're going to have a Meetup once a month, but if it takes you 5 to 8 times for people to know, like, and trust you enough to invest with you or bring you deals or whatever, well, it's going to take us a long time. It's going to take us 8 months before we're really there. So how do we accelerate that? So that's where we created a Facebook group. We sort of took them from Meetup, we channeled them over to our Facebook group, and that's where we really started to engage with people on the regular, like going live, creating content there, and creating community within the Facebook group. So when the Meetup came, it was like momentum going into it, not just like this sudden pop-up meetup and then it goes away and then a month later it pops up again. So those two things I think were really huge. If anybody's considering doing a meetup, I would say to create the meetup and just take the action for sure. And then you need to figure out how to engage with people in the middle. And I'll tell you, that is, people think, oh, there's a lot of meetups, but those meetups fall apart all the time because people aren't willing to do that middle piece. They're not willing to consistently engage with their community in between. And it's a lot of work, but it's the thing that gets momentum in a meetup. So those are a couple tactics. Got
you. Now, I hear somebody saying right now, like, man, like, dang, that sounds like a great idea, but I don't know what the heck to say in these meetings. So, how did you come around that side? Did you bring in speakers, or what did you do for the actual meetups yourself?
Great question. So we went through different iterations of this. So I would say do whatever you think makes sense, and then you can adjust it. But here's what I learned. When we started, it was, hey, we got to have a topic, right? Something to talk about. So first couple of meetups were my partner and I, even though we had no multifamily, by the way, like you don't need to have multifamily. We had a little knowledge, and we were building community more than we were saying, hey, we're the experts, come see what we have to say. But first month we put up our business plan, which helped people like, oh, that's cool. Can you put that together? That's what you give to brokers. Second month we did a deal analysis. But this was all at like an insurance agency conference room, like in their office. So, I went and bought snacks and put it in their little kitchen, but it's sort of, business feeling at 7 o'clock at night. It doesn't have like a loose vibe to it. So people gave feedback like, hey, this is great. The content's great. But man, I want more time to network. Like, it'd be better just to network with people. So I'm like, what, good idea. So I found a restaurant on a Wednesday night that had kind of a front room. I said, hey, can we just cordon this off for us? They're like, it's a slow night. You guys can have it. We'll just let you have it. And we get 20, 30 people to come to this. And it would just be that. Music, drinks, loose. I'd say I do a quick intro, a round of intros. I do like what was it called? Have, I forget what it was, but it would be like, hey, who are you and what do you want or have or give? What do you want, have, or want to give, or whatever the case may be. So people would say, I'm so-and-so, I am looking for X, or I'm so-and-so, I'm a private lender looking to place money. So we do that, but then it was just pure networking. And that got kind of old after 3 months, like, cool, we're all together, I see everybody. So after that, it was sort of, let's blend this a little bit. And what I found the right formula to be is have your networking. So first of all, have a venue where there's music, drinks, and food, one way or the other. But quiet enough, or you can make it quiet enough and private enough where you can have somebody speak and it's not hard for people to hear that person. So we started with, we went to actually a local country club. So here's a little hack. And I got this from a guy named Dan Hanford, who runs the Multifamily Investor Nation. Some people may know him, but he said, hey, check out clubcore.com, clubcorp.com. It's a chain of country clubs around the country. And you can get a reasonable membership price at these country clubs. So I'm like, well, I hate golf. I don't like it, but sure. Let me take a look. I Google it. Literally, like, the neighborhood over from me is a Clubcore club. It's like a minute and a half from my house. I had no idea. So I go on, and they have a social membership for $100 a month. So for $100 a month, I have access to the club. the restaurant, and then they're like 80s nights and trivia nights and stuff like that. But I also get free event space. So all of their conference rooms are free event space. So music, drinks, right? People can pay for their own. And I've got like an AV setup, all included in my $100 a month. An AV setup for my speaker. So it was a great place to go.
Right.
So we went there, and I do this. So come in, there's networking with music and drinks. We have a kind of an announcement of when it's time to eat. Like, if you want to eat dinner, here's the menu. We got like a limited menu from the country club. They can pick from 3 items that I chose. People can order their own meal. They pay for their own meal. But hey, order now so it's ready by X time, because that's when our speaker's going to come up. And then I have a speaker come up for 30 to 40 minutes, not much more than that, unless it's like really compelling, or if there's a ton of Q&A, fine. But 30, 40 minutes, about an hour in, that gives enough time for networking. The speaker doesn't just ground the thing to a halt. Like, it's only 40 minutes. So then there's still the desire to hang afterwards. So music comes back on, drinks start to get ordered, and people stay. Some people take off right away, but people stay and hang out, and they do their thing. So that to me is the right formula. Like, you got to have networking up front. You got to have a speaker for 30 to 40 minutes and networking at the back end. And I'll give one more tip. And that is, unless you literally like hire a professional speaker, or if somebody is a professional speaker that's willing to come to your event and speak, or if they're a billionaire, literally, or something like that, you need to facilitate the speaker's conversation, because no matter how well-intentioned they are, no matter how much you've explained what you want them to speak about, they go rogue. They just kind of go off, and you're like, that didn't land. That didn't land right where I wanted it to, as far as the content that we talked about. So have the 2 chairs up front or whatever, where you're sitting and interviewing the speaker, so you can make sure the questions get out and get answered that you need answered for your constituents. Don't let the speaker just kind of roll. It's good intentions by them, but they'll just go in different directions on you.
No, that's a really great tip, man. Like, I hope you guys that's listening right now, you're writing these notes down. He's dropping straight gold, man. You ought to you guys ought to send him a check in the mail. I'm telling you, this is pure gold, man. I appreciate you sharing all that, for sure.
Of course, man. Of course.
Good deal. All right, man. So let's jump back into the real estate side of this, as far as the finding deals. So you're going through brokers to find deals. So when you get the deal on your desk, how do you know if it's a good deal? Like, what do you look for that says, hey, man, this is a solid deal for me?
I go to debt coverage. That's kind of like, as I'm thinking, as you ask the question, I'm trying to like just let it hit me. Like, debt coverage ratio hits me first. Like, where is it in place, and what can it be? So I look at that first. So is it a 1.3, 1.4, or is it like a 1.15 with potential for more? Where are rents versus the market? If I kind of know the market and I look at rents, like, wow, this is a one bed units at 550, but this market's at least 750. Let me take a look at that, and I'll dive in a little bit. So I look for that. I look for the potential value add. So debt coverage, the potential for value add. Those are probably the big 2, honestly. I mean, I'll look at cost per door versus the rent. So, you charge an 80 a door and the rents are 600, like that's a flag for me. The 1% rule or whatever, I'll use as a quick check on it. Those are some of the things I'll look at as I glance at a deal to see what's what. But honestly, I'm looking more at like our soft criteria. Like, is it mom and pop? Is it, is there upside on the rents? Does it look distressed? Like, there's some opportunity to kind of, take care of some deferred maintenance, some CapEx items. Like, does it have those elements to it or not? Or does this look like like, I'll get a deal across my desk that's like, wow, this is beautiful. Next, right? It's just not in my criteria to invest in that. Well, it's sort of like an eye test on it a little bit. Like, no, this is garden level. There's a peaked roof on it. It's not flat. That's good. 25 units. It looks a little tired. I'm liking the look of this so far, and then I'll dive into a couple of the financials. Got
you. So what deal size are you looking for, as far as, because you said mom and pop, so are you thinking what, maybe 60 or less, 50 or less? Like, what are you thinking?
It's funny. I've gone all over the place on this one. We started out, we were looking like 25 and under, right? And we found that 16, 20, 22, right? We found those deals. And then it became like, hey, we got to go bigger. Created a fund. We had a raise that we wanted to do for that fund, and we still have that. And if we find the right deal that we can syndicate and use that fund, we will, for sure.
Right.
But what we found is, man, there's so much noise in that space. There's almost like a jump from 3 years ago to now of like, no one's in multifamily, right? Everybody's single family, and multifamily seems big and scary. Then everybody kind of touched multifamily and got like a 7-unit or a 12-unit, and then immediately they're going to 150, right? So I feel like what's left in the middle is where my partner and I, we were just talking about this morning. We're sort of navigating back to a little bit like, the right 180 unit deal comes
Yeah.
up that we can syndicate, cool. But the place where people aren't looking as much, in my opinion, are the 12, 15, 18, 25 unit properties. So I think
Yeah.
we're kind of there when we want to buy, or it's
Yeah.
got to be really big if we want to syndicate, if that makes sense.
Right.
And here's the evidence of that. A 36 unit, I think it was, property came up. Broker sent it to me. I have a good relationship with this broker at this point. Said, hey, not on market yet. Take a look at it. And I analyzed it, and it was like, yeah, everything we wanted, right? As far as tired, B plus, or I'm sorry, B minus C plus type property. Needed some maintenance work done on it, and we drove the property and everything. But it was like 36 units. We told them what we could offer. It was well below what they were asking, but they put it on the market. It got 32 offers. Like as soon as it hit the market. I don't see that at the 12, 15, 18 unit level, right?
Yeah.
I see that when you start to get over 30 or even over 25 a little bit.
Right.
Like people look at that as like the spot where they want to be. That's not with the big boys, but not too little to, be a little annoying. Like that 30 plus people are really, really hot on right now. So long answer to your quick question, but I feel like we're settling in right now and seeing opportunity mostly in that up to 20, up to 25 unit range. So that's where we're sort of focused right now. But again, if a 50 unit came along, we'd buy it. If the right one, or if we found one that we could syndicate, we'd do it. But if Ben, we just said this morning, if we bought 3 more like 20 unit properties in the next year or two, we'd be very, very happy with that. I think that's a nice place for us to be. So that's kind of where we're focused.
Okay. Now let me ask you a question around that, because most people that I bring on the show, they're trying to do the bigger deals and a certain unit count so they can have on-site management. So what's your strategy around, let's say you find a 15 unit, are you going in markets that's around you? Or let's say I'm in North Carolina and I'm a broker here. Let's say I bring you a deal, hey, it's 16 units. Would you look at that, or do you need to have boots on the ground for that market for it to make sense for you?
We have a great property manager in our Michigan property. They've done a great job for us. They push rents. We just looked at an 11 unit property. The first call I made before I even looked at it was, will you manage this in that market? When they said yes, I'll look at it. So if they said no, I wouldn't look at it because I'm not going to manage it. We've done that. Right. That's not going to happen. Right. There's other managers in that market, but I don't want to vet and have multiple management companies. So for us right now, we're interested in the management company being able to manage the property. The management company we're using being able to manage this property that we're going to buy next. In fact, we're looking at a larger property, about 180, 190 units. It's actually for sale by the owners of that management company. So one of the things was like, send me that deal, but you'll manage it. We got it. Cool. Then I'm willing to look at that deal. So I've almost limited my criteria to we found the right partner as far as a management company. I should partner in the sense of business partner, not like equity partner.
Right.
And if they can manage it, then absolutely it's on the table for us to look at. So I'm not saying I would not if it was the right deal in North Carolina, because we have some connections through our communities to different markets or whatever. But it's going to be first and foremost like I got to find the right PM that's going to manage that property that we can trust, and that would have to come with referrals from guys like you and others in that market that know this is a lockdown PM. But for the most part, we're looking around where we've got property managers, our property managers.
No, that makes perfect sense. Now, let's talk about deal structure for a minute, because you guys are not syndicating because the deals are not as big. How do you guys typically, structure your deal? Because I imagine you may still be bringing in capital in some form or fashion, right?
Yeah, a little bit. Like, so on the one that we bought, the 16 unit, we actually started with 4 partners. We bought out 2 of them, the other 2, I should say, recently. So Ben and I are 50-50 partners on that building. But we did bring in some private capital at the beginning just to take care of, I think it was like 50,000. It wasn't a ton. Yeah. And we structured that as pure debt. It was no equity play in that. We gave a return that they were looking for. Again, this isn't big dollars that we were getting from these 2 people, but we gave them a return. We deferred the payments. In one case, we made monthly payments in another, so 2 $25,000 investments. And we just went straight debt. We found the right people that wanted to just like, I want to place my money, just get a little bit of a return on it and then move on, not wanting to buy into the property at all. So we've learned to be protective of equity. We had good partners. It wasn't a matter of that, but we just saw things kind of differently. And we've learned to be protective of our equity in any case. So from this point forward, unless the deal just is screaming and we can be majority partners in it, the plan is Ben and I are 50-50 partners, and any capital that comes in is pure debt.
Yeah. No, that's a great point, and I want the listeners to really hear what you said there. So this is where we talk about creative financing and getting deals done. You know what I mean? Because you may see a solid opportunity, and you may just be starting your investing journey, so to speak, and you don't have the capital to put down. But there's plenty of investors out there that have money on the sideline that if you guaranteeing them a certain return on their investment, they will put the debt up for you. And it's all about how you structure it. So, I mean, I appreciate you sharing that because,
Yeah, of course. Yeah, we essentially went hard money on that, right? It was private money, hard money. It was like a 10%. I think we gave a couple points up front, 10% annualized return, and then a couple points on the back end. And that's how we structured it. So yeah. It worked.
Yeah, no, that's awesome. That's awesome. All right, man. Last question for this section here. What's the biggest rookie mistake you see people making? You kind of already said it, but maybe you can give it a different way.
There's so many.
Yeah.
Which one are you referring to? Just so I know.
The one I'm referring to is, trying to go big or go home, like the Great Cardones of the world.
Yeah. I mean, it's a good, if you can go big, go big. I'll go with this one. And this was a rookie mistake we made. I don't even know, mistake or learning, whatever you want to call it, but self-managing. So here's an example, right? So I'll go back to the 16 unit because it's the one we're most actively involved in. The 22, we're more passively active, if that makes sense.
Yeah.
So the 16 unit, we bought it and we decided, hey, let's self-manage this thing. At the time it was like, well, the rents are low. We got to get them up. There wasn't a lot of margin on the property, but a lot of upside. Right. And when we self-managed, like there was definitely like a relationship built with the tenants where it became difficult for me to be the landlord sometimes. Right. It was like, this poor guy, you kind of, okay, if you do it next month, not that you kind of get into those, even though you know not to, you get into those little bad habits. Right. And then on the other end of it, like we weren't willing to push maybe rents, for instance, to the level that they probably could get to. Just something about it, like we were limited in our belief with this. Versus when we hired a management company, all of a sudden it was like, we can get what for rent, and we are getting what for rent. And, I meet with the property management company once, twice a month, and we have a conversation about what's going on. And I can turn my time and energy into way more dollar productive activities, which for me is finding deals, analyzing deals for sure, but also building our community and adding value to the members of our community, which we've seen a return from. So self-managing can be necessary to learn maybe sometimes, but if you can avoid it, even if you're making no money, you have to bring $200 to the table a month, right? Hire a manager, hire a good property manager, and let them do what they need to with the building. We would have probably, even though at the beginning it was tight, we probably would have been, breaking even at best, but we would have repositioned that property even faster than we did. We did it in a year and a half, but we would have repositioned it even faster had we had good management in place, in my opinion. Yeah, no, that's really good advice. And that transitions us into the next segment of the show, the deal deep dive. So let's talk about that deal. How did you find it, number one? And then number two, what was the value add that you've seen or saw that made sense to you in it? And, how did you go from there with it? Do you still own it, or did you sell it, or what? Yeah, no, we still own it. So we got it from people that came to our meetup. So they brought the deal to us, said they'd like to partner on it. We got to know them and we decided, we'll go for it. So 25% each, we bought the property, and we each brought $55,000 to the table. So $220,000 down. That was for needed a roof, needed some other CapEx items, as well as the down payment and closing costs. So that's what we all brought to the table. We saw the rents on average were $578 a door. The owner was an older gentleman. There were 16 units. 2 of them were 2-bed, but he didn't advertise them as that because he wanted what he had, which was pretty much older, retired, quiet people. He didn't want kids in a second bedroom or anything like that. So rents were even across the board. And he would sign like 3-month leases and then let them expire and just go month to month. That was just what he did. Right. Some of the leases were from 1999, without any movement in rent. But I mean, that was like the extreme one, but even still, there were a lot from like 08, 07, 09, 2011, and we bought this in 2018. So long-term tenants hadn't moved their rent in ever, maybe a little bit here and there, but almost ever. And we saw that rents we thought could get to 700. That was kind of our target. Like we could raise rents, we'll say at least $120. We thought it could be more than that, but conservatively 700, like aggressively, maybe 725. Like that was what's in our mind. Like I'd be able to get to 725 on this. So that's how we found it. That's how we bought it. We still own it today. We refied out. Do you want me to kind of go through the repositioning, or did you have specific?
Yeah. No. Let's go through that.
Go through it.
Yep.
So when we bought it, we went around to all of the tenants. We brought them little care packages. We said, hey, what maintenance item do you have that you need us to fix? What's something that you need to help on? Because one thing we knew was we could raise rents very quickly. Like even if we raised them on these existing tenants, we knew there'd be an uproar. But when they look around, they're just not going to find that rent level to move to, right? So we went around and we just got to know them a little bit first. We fixed something in their apartment for them. Hey, I got a leaky faucet. Hey, my toilet's doing this or whatever. So we just sort of did that for the first month or two. Get to know them, clean up things for them. We also had a strategy when we went in to upgrade the interior, like the common areas, new carpet, fresh paint, all that stuff. And we wanted to convert it to a non-smoking building or 2 non-smoking buildings because it's just class of tenant, all of that goes up when you don't have smoking.
Oh yeah.
So we went in, we did the cleanup of the common areas. We brought in new washers and dryers. We did all that stuff. And we then sent them a letter with what the increase in rent would be. So what we did was, regardless of where they were, we brought them all up to $675 for the 1 bedrooms. I think it was $750 or $725 for the 2 bedrooms. So we went up to $675 for the ones and $725 for the $725 or $750 for the 2 bedrooms. One person left, which, you know what, not a great tenant. The place was covered in nicotine when he left. So that's fine. He left. I don't know what he found, but he left, and we turned that unit. And when we did, we got, I think we got it for like $725. So we're like, wow, we're already ahead, right? $725 on this first unit turn. We then had to kick out the former manager or maintenance guy in unit 1, because not only were they smoking heavily, they wouldn't stop, but the wife had an oxygen tank. Like, she's walking around with an oxygen tank, smoking a cigarette. Like, talk about a hazard, right? Just gonna go up and smoke here. So we ended up kicking them out. But even still, like, we found them an apartment. We gave them, like, I offered to help them move. It wasn't like, get out of here. Like, we were trying to do this in the right way, because small community, 16 units, they all talk, they all know each other, and they're going to want to assess what's this new manager like in the way they treat people. So we treated them very well, I think, in helping them move. So we brought in that rent, I think, at $745. So now we're like, wow, we went $725. Now we're at $745. Then as time went on, somebody else decided to move out, and we turned that unit. Now we got $795. So we're going like, okay, we're getting $795. One of the 2 bedrooms turns. We're getting $850 for that 2 bedroom. It's like, this is way better than that $700 we were thinking that we would get, right? So we're starting to turn these, and we get to the point where we're going to refinance it. We call our bank. We go for the refi. The plan the whole time was for the 4 of us to refi, take the proceeds, go buy something else. But our 2 partners said, hey, look, you know what? We actually want out. So we're like, oh, wow. Okay. So if we refi at this level, we have this much in proceeds. Can we buy them out with those proceeds? And that's what we ended up doing. So we essentially took the refi proceeds that we were going to buy something else with and bought the other half of the same building by giving it to our former partners. But we bought it at $755. We refied out about 17, 18 months later at $1,040,000. And that $1,040,000, by the way, was in COVID. And the appraisal was just like, it was watered down because of COVID, the uncertainty. It was sort of the beginnings of COVID, and even said there's a lot, all of them do right now, like the uncertainty of COVID or whatever. But even when we went to challenge it, the bank was like, look, we're not even accepting any challenges to appraisals because of COVID, the uncertainty of the future. So anyway, $1,040,000, we felt it was worth closer to 1.2, but for us buying out our partners, it was actually better that it was lower. So we refied out at $1,040,000, took most of the refi proceeds, paid off our partners. We kept the rest in the deal, and we cash flow, a couple thousand a month on the property.
Nice. No, that's a huge win, man.
Yeah, it was good. The cool part for us was like the credibility for ourselves, the mindset piece, right? Like, we executed on the strategy we said we would. We can buy this, we can get it here or whatever. Now, after that refi, with our manager in place and all of that, right? The most recent 1 bed, I mentioned we went 725, 745, wow, 795. The most recent 1 bed rented for 925. So without that property manager, pushing us like, hey, you guys are staying down here in the 7, like, why don't you go here? Like, we're looking at the market. We don't see, anything that's even close, like, you could push rents to 925 on a 1 bed. And we're like, nah, no way. But my partner was like, why don't we just let them do their job? Like, good idea. Back out of the way. And they got a renter at 925, man. So So
Wow.
our average rents are approaching like high sevens at this point.
Yeah.
And that's way above what we thought it would be when we first bought it.
Yeah. So I imagine then you'll probably wait another 2 years or so and then refi it again.
Spot on. That's exactly right. That's what we said. Like, let's get past COVID. Let's turn some units. I'm sure they will, or continue to increase rents as we have been. And our managers are putting really good strategies in place for increasing rents. Like, if they renew in the winter, rather than doing a 1-year lease at the next level, do a 6-month at the next level. And then at the 6-month mark, because it renews now in the summertime, which is a way better time to rent, renew for a year and increase rents again, because we're still, the newest people or the oldest people that were there, we went to 675, 695. Some of them are getting to 720 now.
Yeah.
But those apartments that we haven't turned, we're getting 925 for a renovated unit.
Wow.
We could still probably get close to 800 for these apartments. Now, we don't want to do that to these residents. We want to keep the residents intact, but a little bit more aggressive in spots on raising rents has been effective for us. So yeah.
No, that's cool, man. I imagine, man, people listen like, wow, that's crazy.
It is. And it's like the stuff we kept hearing on podcasts, like, this is what other people do. But then it's like, wow, it happened for us, and it is crazy. It's sort of surreal, but it's working.
Yeah. I appreciate you sharing that story, man. All right. So let's go ahead and transition to the last segment of the show. It's our lightning round. A couple questions for you. What's the best advice you ever been given?
Just generally or in real estate?
Just in general.
Do you. Best advice I've ever been given, best advice I give now. Just do you. Don't worry about what everybody else thinks or thinks you should do or what their opinions are of you. Do you. And whether it's in networking or building your business or whatever, it's hard to do. Trust me. I mean, I'm not an expert at it, but just do you.
Got you. That's great. Best book you've read the last 12 months?
Oh, God. So many. Last 12 months, I'd say the best book I read might be Shoe Dog by Phil Knight, the story of Nike.
Mm-hmm.
Just I've gotten into biographies more because you can kind of glean the lesson versus getting the lesson,
right?
And being told the lesson. And that book just spoke to what I mentioned before: perseverance, consistency, overcoming. Lots of lessons in that book. I struggled putting that one down.
Yeah. No, good stuff, man. What's some rituals that you've created that's making you a better investor or person in general?
I'm big on morning and evening routine. So my morning routine, I kind of stick to kind of the miracle morning, but I do it my way. So, I'll get up. Meditation to me is absolutely number one, because my brain, the moment I wake up, it's like all of my thoughts have been just sort of sitting there staring at me. And when my eyes open, they're all like, hey, while you were asleep, I was thinking this. I was thinking, like, my brain's just alive as soon as I wake up. So I need that 10, 15 minutes in the morning to just sort of calm myself down and get myself clear on what I want to do. So that, that through exercise in the morning, visualization, those rituals in the morning. And in the evening, I do everything I can to set myself up for morning guy. So I lay my clothes out, even if it takes a minute, just because in the morning, I know it's my mind isn't quite, foggy. Right. So laying out my clothes, reading a little bit at night, kind of taking myself down. But the other part of that ritual, I think, is, I have my day job, right? I have my investing career. I've got my multifamily and more community. I'm part of this other community called GoBundance, and I'm doing some work with them I can mention at the end. So all of that takes a lot of time. Plus, wife, 2 kids, all of that takes a lot of time. Right. So every Sunday I spend 1 to 2 hours sitting down and looking at, what are my goals this year? What are my goals this quarter? What are my goals this month? What do I need to do this week to stay on track with those goals? And I map that out, I plan it. But I also look at, kind of chunking together things that are similar, like, oh, wait, I've got a dinner party coming up in 2 weeks that I got to go to. And I got to go to the store this Wednesday for something. Well, let me get the case of wine or whatever that I'm going to get for that dinner party this Wednesday. And you know what? Let me take out the cash from the ATM at that point for the sitter, so I don't have to worry about that later. You know what I mean? Like, just taking all the stuff and chunking it together so that I get 28 hours in a 24-hour day, I feel. So that's kind of my biggest ritual, I would say, the weekly planning every week.
Gotcha. No, that's great. That's really great. And if you could narrow it down to one thing, what is the one thing you're focusing on right now to improve your business?
I would say building the community of multifamily and more. That is number one for us right now.
Yeah. Awesome. All right. Last question for you, man. If you can give yourself, your younger self, one tip in regards to investing, what would that be?
I would say create an account that you don't see, that you can't touch, funnel money to it, even if it's $10 or $100, whatever a month, just a little bit of money to it, something you won't ever miss. And then look up in 5 years, take that amount and go invest it in something.
Yeah. No, that's great. I haven't heard that one, man. That's good stuff. Good stuff. Yeah. Well, yo, Jamie, I appreciate you coming on the show, man. That's the end of it. Tell my listeners, how can they get in touch with you?
Sure. So check us out, Instagram at Multifamily and More. You can go to YouTube, youtube.com/multifamily and more. We got a bunch of content on there if people are curious on how to learn about multifamily and more. And I'll just throw this in there from a mindset perspective.
Yeah.
I work with this mastermind called GoBundance. Again, it's the tribe of millionaires. I'm privileged to be a part of it. And we put together some really cool goal setting stuff that's out there. So if you go to gobundance.com/goals, you'll see a webinar I did with David Osborne, who, if you don't know who he is, he's a best New York Times bestselling author. He's worth well over 100 million, private jet, all that stuff guy. He really goes deep on goals and how he sets his goals and everything. So gobundance.com/goals, you'll be able to see the webinar and hopefully take that information and apply it.
Good deal. Good deal. Appreciate you coming on, man.
Of course. Thanks for having me, brother.
Absolutely.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.